21,680. That's a crucial level. We'll have an expiry move maybe in the next 10 minutes or so. So let's see how that plays out. But let's welcome Sanjay Parekh, founder and CIO at Sohum Asset Managers, who joins us on the show. Hi, Sanjay. Good afternoon, and wishing you all the best for 2024, you, your team. And we wish all your clients as well. Hopefully you make a lot of money for them. But let's find out how you're thinking about the markets at this juncture. We've had a good run in the last in the last year or so. I think you're more inclined towards the large cap names. So do you think that continues for this year? And if yes, from the large cap basket with due disclosures, what's that one stock or couple of stocks that you're really bullish on?
Thank you, Nigel, and wish all of you a happy, healthy, peaceful, and prosperous year. So yes, we had average 78% large cap over last night. I mean, ours is a large cap oriented fund, and over 19 months, and we always believed, that there is significant alpha possibility even there. And as you see the 1 year divergence within Nifty, the top 10 average of the top 10 has given 65% return, while the worst of the top 10 is 4%, when the Nifty return is 18 to 19%. So, and that's what we've tried to do, of getting the best 18-20 names and positive. I mean, luckily we have good alpha over last 18 months. So our market view is, on valuations, as you would appreciate, are not cheap. If we take earnings, which are reasonably at 1100 for 24-25, at 20 times we would be at 22,000. But 24-25 is yet to start, so maybe 6 more months and 6 to 9 months more, and that's where it gets reasonable. But if we move to 25-26, which is 15 to 18 months away, there broadly, if we take nominal GDP plus growth for earnings for Nifty, we can broadly get to 1250. And at 1250, and now India's average price earning over last 5 years has been around 20. So on a terminal value, 20 times, it's 25,000, which is quite good. But if on an annualized basis, it would be 12-13% return. So that's what we think, that, we could be pausing for 6 months or some reaction and a good time correction, a little bit of price correction, and then we go back to that level for next 15 months. And that's what our view is. So this is a zone where we think it's more to be less active, and pause is what we think is the right thing to do.
Okay, well, Sanjay, you mentioned pause, and that's one thing which didn't take place for the broader markets, the mid caps as well as the small caps last year. What is your sense? I mean, your allocation is less. Was there any kind of feeling of missing out? And what is your sense for this year? Do you think that gains will probably be much more tempered as compared to the large caps, and hence maybe there is no sort of need to reallocate your portfolio?
So we are happy, because our positioning has been that in mid and small cap, our average mid and small cap weight was 22%. And luckily there again, we could get very good winners. Some of it we still hold. Some of it, we big book profits. In the EMS space, cinema is what we held on. In railways, Jupiter Wagon was almost 3x for us. We still own Angel, which we bought. It's all again 3x for us. So we do buy the right businesses at the right valuation. With that mid and small cap also, we're happy that our alpha was significantly higher at 19 months at almost 13.5-14% for Nifty TRI. This year, we believe, there is certain segments of mid and small cap where clearly there is froth, and one has to be very, very selective. There are opportunities even in mid and small cap, but the margin of safety has to be higher, because the broad flows are, where the valuations are not cheap. So one has to be very, very selective, have the right margin of safety, the right framework, and then look for opportunities. That's what we are going to do.
Okay. Sanjay, hi. Good afternoon. Season's greetings to you. Just want to get your good afternoon. Just want to get your thoughts on the entire new age space, because that's where we've seen an appreciation in stock prices, and underlying business fundamentals also seem to be improving. If you were to allocate more money to technology, would you look at some of these new age players, or even newer companies that may come in list, or would you look at traditional IT services?
No, so traditional IT services, we are underweight now for 19 months. We continue to remain underweight. You see in the interim some outperformance, but we continue with our stance because we're clearly not seeing earnings growth even of 10% plus. And that is a worry we have. They have great returns, ROCs are very high, payouts are very high, and hence we will consistently remain underweight. On the new age digital companies, we do own, delivery, which is in the logistics space. We do own Paytm, which is in the payment space, and stroke the lending franchisee that they have. And I think what we are seeing is that where there is a critical mass, there is a size, they have significant cash, they have a right to win, and they are last one to, fall down. And they stop burning cash, which is the most important criteria. And then, reasonably, they would be profitable over 25, 26, 27. And if you take those 26 and 27 numbers to NPV, there's an upside. So these criteria, based on these criteria, both of them we like and we hold them. And we believe that they have a clear right to win in the respective space, and that could be good compounders over the next 3 to 5 years.
Okay, all right. Sanjay, I wanted to ask you about one of those stocks that you think, has run its course from your portfolio, something that you'll have lightened your position. If you could, tell us about that. Because as you said, many stocks are up twice, thrice as well. But some of them could have run a little fundamentally ahead, right? So if you want to tell us a couple of themes, a couple of stocks that you'll have lightened position.
Yeah. So I'll tell you, Sirma is what we already booked profits. It was, in hindsight, a little early, but we genuinely felt it was overdone and we booked our profit. Angel One is, has gone up 3x from the last 12 months. And again, it's a great franchise, run very well. They've grown. The investor base, they're profitable. They would do at least 1,100 crores of profit, which is free cash flow. But we think, it's run too fast. We do own it because we don't keep buying, selling, and we did book some profits. But I think it's one of them which you said, which is now not cheap. So but we do like them over the next 3 to 5 years. We think it's a great franchise. So we do own some of it. But this is one which I think is run faster. This is where we would not want to buy. We'll hold on for a while. That's okay. But
do you think? Sure.
Yeah, please.
Sanjay, do you think there's some amount of froth in the entire real estate space?
Yeah, so real estate space is the single largest asset, right? Equity, it's larger than equity, right? Or the ownership wealth in real estate is larger. And the overall space of listed was pretty small. So we saw that bump up and, almost now 2.5 times from the lows, certain stocks at 3 times. But the opportunity is very large. But now when we see that, real estates are clearly NAV. You have to look at the net asset value of the company. There is some profit earning capacity. You can give some premium. But we see now that, the upside is limited in a lot of them because most of the NAV is getting captured. Even the future potential is getting captured. So now one has to really dig hard, look for those, mispricing if there is any, and be careful now while investing into real estate. But as a theme, we are overweight. We own Century. We'll continue to own it. But we'll be very selective now to add to our real estate exposure.
Okay, all right. We will leave it on that note. Sanjay, thank you very much for joining in, and once again wish you a fabulous 2024. Do have to take a quick We do have to take a quick break on that note. We'll come back on the other side, and as usual, all the buzz from dealing rooms coming up in the street chatter, and then some final trading calls with Mitesh for the last half hour.
Well, thanks so much for tuning in to CNBC TV18. Make sure you follow us and stay updated on all our social media platforms.